The loans that real estate investors love don't use tax returns, pay stubs, or even personal debt to income ratio. Does this sound too good to be true? It's not. It's real. It's called a DSCR loan. And in this video, you're going to learn a little bit about what they are, who they're for, and three mistakes that investors make that can sink a deal before it ever leaves the dock. I'm Christy. I'm the home loan mom. I work with investors, business owners, and regular families to demystify mortgage because I believe when you know more, you worry less. So let's talk DSCR loans. What are they? It stands for debt service coverage ratio, which is a fancy way of asking, does this property's rent cover its expenses? We don't need to take into account the taxes or the pay stubs, any of that, because we're working off of the income of the property. And that's a huge difference and very impactful for real estate investors. Okay. So let's give an example of how this works. So we're going to divide the monthly rent by the all-in payment. Now, the all-in payment is otherwise known as a PITI and sometimes A. Principal, interest, taxes, insurance, and association, like an AOA, HOA, if any. So we divide the rent by the all-in payment. That equals our debt service coverage ratio. So our example today is going to be rent of $2,400. Now the PITIA on this property in this example is $2,200. So when we divide that, we're going to get a DSCR of 1.09. So this is a little bit above break even. It covers all-in costs for the property each month with a little bit left over. Kind of the gold standard of a DSCR loan is 1.0 or above. So most of the time, if a property has more than that, it's going to qualify as long as a couple of other things are met. If it's less than 1.0, it still might. We do these all the time where there is a property that maybe doesn't cover all of its debts, but that's okay. There are programs for that. But in this video, we're just going to kind of keep in the back of our minds the 1.0 because that's kind of the standard, like I said. Real estate investors like DSCR loans. Well, aside from the obvious, not having to provide all of their personal tax and income information, DSCR loans are scalable. It's easier for an investor to have multiple properties, each with its own DSCR loan, because we don't have to take into account all of their other loans. Another reason real estate investors like it is because most of the time you can close in an LLC, and that's an important distinction for people who are buying rental properties. Who are DSCR loans for? These are for real estate investors, whether it's your first one and you're just getting started in building your portfolio, or it's your 10th or more and you're expanding your portfolio. These loans are great for anybody who is looking to, grow their real estate portfolio and expand their generational wealth. So that's what they're for. What are they not for? They are not for people who want to buy a primary residence. These are investment only loans. They're not for a house that you're going to live in, not for a house you plan on living in, and not for one you want to sneak into. We have lots of options for primary residence purchase loans and refinance loans for people who don't have W-2 income, like business owners, but this isn't it. This is for investment only. The types of properties that qualify for DSCR loans are single-family residences, condos, townhouses, and multi-units, a duplex, a triplex, all the way up to 8 units. So these are very flexible loans, and they're really, really great tools for building and expanding real estate portfolios. So what does it take to qualify for a DSCR loan? Because so far it sounds too good to be true, But like I said, it's not, but there are things that are required. So you do have to have decent credit, high 600s and above. The higher the credit, the better the pricing is going to be on the loan. But we definitely see investors who come in the high 600s, and that's far from perfect credit. So don't let that be something that stops you in your tracks before you even start the research process to see if you can buy an investment property. The next thing you need is reserves. So this is a minimum of 6 months, sometimes more, depending on the program, of your all-in payment, your PITIA. You need to have at least 6 months of that somewhere that you can access it if needed. And it can be retirement accounts, it can be investments. It doesn't have to be liquid cash sitting in your checking account, but you do have to have it that you can show that you can tap into it if necessary, if something happens to the property and maybe somebody leaves or stops paying the rent. So reserves are required. Obviously, you're going to need a down payment. A down payment is required. The conventional wisdom has been 30% down required for an investment property. Well, that is no longer true. Depending on the situation and the program, we can go all the way down to a 15% down payment. And again, it's going to depend on a lot of different factors, but it is an option. So keep that in mind. And the last thing we need for qualifying is verifiable rent. Now, this can be an existing lease that's in place. It can be a rental income um, survey on an appraisal. What it is not is what that amazing one-off listing you saw on Zillow, what it's listed for that's way above the market. It's not that. And it's not what your cousin is paying in rent across town. It's not hoped for rent. It is verifiable income for that property that's required. What's not required, typically, tax returns, W-2s, pay stubs, those things are not required. Okay, I promise the three mistakes that I have seen repeatedly that can just completely kill a deal before it ever starts. The first one is using principal and interest only when you're doing your math, because a deal might look great, but if you forget to add in the taxes, the insurance, and the HOA, you might be looking at the completely wrong set of numbers. And when you add those in, it might make your ratios so far off that the deal is not doable. So always make sure you understand all of the numbers before you fall in love with that property and start the buying process. The next thing that people forget to do is to understand that it's verifiable rent. We cannot count on hoped for rent. Like I said, it can't be the rent that you saw listed somewhere that we can't verify. So when the appraisal is done, it will have a rental assessment on there that shows what the anticipated real market rent is for that property. Or if there's a lease in place, we can use that. If it's a short-term rental, we can use something like Air DNA data, which shows what that would be expected to bring in as a short-term rental. So we definitely have those options. So just remember, though, that you can't just guess what you think the rent might be. It's got to be verifiable. The third biggest mistake is emptying your accounts for that down payment. So not only do you have to have reserves anyway, you want to have them. It's very stressful to own a property that you barely can cover. And if you don't have a padding for things that come up, you are asking for a lot of sleepless nights because there's always going to be maintenance. There's going to be turnover costs. Maybe the place is empty, it goes unrented, or heaven forbid, a renter stops paying rent. And there's always a water heater that's going to go out in the middle of the night. So you need to have that padding. And that's one of the reasons why reserves are required because, no more, worry less. If you know you've got money in the bank, you are going to worry a whole lot less if something happens to that property. Okay, here is the rapid fire of my FAQs. Can I close in an LLC? Yes, most of the time we have a lot of programs that allow for people to close in an LLC, which is a very good tactic for most real estate investors. But I am not a lawyer, so definitely get legal advice or tax advice. Don't rely on this video. However, it's often a good idea. And yes, we have programs that allow for that. Does Airbnb count? Yes, we can absolutely use air DNA data. We can use history of rents for that property if it's been an Airbnb. So an Airbnb or other short-term rental definitely is an option with some programs. What if the property is vacant? That's okay. It doesn't have to have a current lease because we can use that rental assessment in the appraisal. So that gives us a really good idea of what that property will rent for on the open market. What if my credit isn't perfect? Again, we already talked about that. Perfect credit, people think of as, 800, but DSCR loans, a lot of them can go down into the high 600s. So don't let that stop you from researching whether this is an option for you. So the takeaway is that a DSCR loan is a fantastic loan for rental properties. Definitely talk to your loan officer. Hopefully, it's me to find out how it could work for you. It's a great way to enter into the rental market, and it's a great way to expand if you're already in it. Follow me for more, subscribe, and if you do that, then and if you like this video, YouTube will serve it to other investors who might need to hear this basic information about DSCR loans. Also, please feel free to share it with whoever you'd like who would like this information. And remember to know more, worry less, and when you need a mortgage, call your mom.